Hello, friends, and welcome to the Optimized Advisor Podcast, where we focus on optimizing the well-being and best practices of insurance and financial professionals today. On this show, our objective is to help you optimize your life, optimize your profession, and learn from other optimized advisors. I'm your host, Scott Heinela. We hope you enjoy the show. Nick Bernatowicz, welcome to the studio today.
Thank you. Glad to be here as always.
I can't think of any better time than right now to be talking annuity shop talk.
Yes, the exciting topic, but definitely a pertinent topic.
Well, I don't know about exciting. Certainly exciting for us.
Yes. We do geek out over insurance a little more than most.
That's right. That's why we get paid the big bucks.
Oh, yeah.
But referencing the time period that we're in, markets in, let's say, high volatility, significant headwinds, rising interest rates upon us, issues with geopolitical challenges. So there's a lot going on.
And clients are looking for alternatives. Clients are looking for solutions. And when I say clients, that could be advisors, our clients, and or their clients, specific consumers looking for solutions and answers to help some of their issues going on in the market, in fixed income, bonds, whatever it might be, that people are out there searching.
What are, maybe you can kind of pinpoint one or two of the most recent conversations you've had in terms of the profile that has been brought to you?
Yeah, especially with the market volatility, with, Ukraine and Russia and potential war and these type things. Market volatility is at I don't want to say all-time high, but it's definitely high. Mm-hmm. And clients, the most recent clients are profiles that we've been seeing are clients that don't want to be in the market with this volatility, right? Either they're in retirement or just nearing retirement. They're concerned about sequence of returns. And so they're looking for some form of principal protection or reduction of risk while still providing some upside potential. And, a fixed or indexed product fits nicely within that profile. We're looking at a principal protected product with a 0% floor, and it can only go up in value, not down. So when you have clients that are concerned about volatility, well, we can eliminate that with at least a portion of their portfolio by instituting or implementing a product like that.
So you made an interesting comment. Let's talk a little bit about a sequence of returns risk. And I'm always a little bit intrigued by just the regular consumers, either ignorance or just lack of understanding or awareness of what this really is. So I would challenge anybody who isn't aware of it to do a quick online search of sequence of returns risk, take a look at it. And I would also make the point that it certainly is one of the most significant risks that faces pre-retirees and retirees. So there's this window of transitioning from accumulation to decumulation. They usually say it's maybe 5-6 years prior to retirement and then 5-6 years post-retirement. And that's when you're most vulnerable to this risk. So let's try and verbally try and describe this a little bit. I'll give a shot at, and you can certainly add some content to that. So essentially, what you've got is, let's start with a portfolio and assume a portfolio value. In this case, which we've created a document on this, so we can certainly provide this for anybody listening and who's interested. Just shoot us an email and say, send us your sequence of returns analysis. But we take a retirement portfolio of $500,000. Client retires. And then we apply a series of investment returns over in this case, 26-year period. And completely random. Now, portfolio one in year one begins with a negative 8.4% return. Year two is 4. Year three is 14.3, so on and so forth. So you get the picture. Portfolio 2, all we do is take the exact same returns, except we inverse the year-by-year returns. So in this case, Portfolio 2 actually ends year 26 with that negative 8.4. In year 25 was the 4. In year 24 was the 14.3. It just happens to begin with a few years of positive returns. So by comparison, you've got the one portfolio that kind of retires at the quote unquote wrong time, right at the time that the market corrects. And then you've got Portfolio 2 that retires, quote unquote, at the right time in a bull market. So they see positive returns. And what's funny, not funny, is that the balance at the end of that 26-year period, and I think it's also critical to interject that we also incorporate a withdrawal rate. So both of the portfolios take the exact same withdrawal starting at $30,000 a year, increased year over year by an inflationary factor. So same investment, $500,000, same withdrawals, identical, same average return in the portfolios. You just happen to have reverse order of the two portfolios. And what do we see? The balance at the end of the 26-year period in Portfolio A, the one that retired at the wrong time or the least opportune time, has a balance of $19,000. Portfolio 2 retired at the most opportune time and has a portfolio balance of $2,553,000, $553,611.
So that's one of the things that is so important for a consumer to understand. In simplified terms, that over a 26-year period, you just said, the average rate of return on these portfolios is identical. You take the same amount of money out of it, identical over the same period of time. Mm-hmm. But you're over $2 million difference at the end simply because the returns at which the portfolio got was in a different order.
Despite the identical average returns, the results are not symmetric. They're diabolically different. And that's a huge risk. So, enter in the conversation a solution that provides a floor of 0 and competitive returns. Certainly we're of the waving of the index annuity flag conversation, but it adds wonderful value. Forget what it's called. I think the industry can do a better job, or just advisors at large. The investment world can do a better job of accepting the fact that you define what this product provides the client and the client portfolio, and try and remove yourself from the conversation of what it's called and some of these biases that we need to get around, especially right now, right?
Exactly. The word annuity gets such a bad rap, and rightfully so, maybe 15, 20 years ago, right, where there weren't regulations around it. It was kind of wild, wild west with the annuity world. In today's world, there's so many different types of products. They're well regulated. They're very consumer friendly products. And as you said, we don't even need to call it an annuity. If you simply speak to the value that the product provides, I think it would be much more beneficial for a lot of people. You can't say, I hate annuities, because if you can say I have a 0 floor, 0 fee product that's going to provide competitive upside returns on a tax-deferred basis, okay, tell me more, right? And I think a lot of people would say that. But when you throw that annuity name on it, it gets the icky feeling for many people unless they have a true understanding.
Yeah, so what I'd like to do next is just talk through how we identify which product solution to recommend based on a given, generic scenario. Annuities are no new phenomenon. They've been around. In fact, they can be traced to Roman times, if you can believe that.
Wow.
and have been available in the U.S. since 1812. That's a long time.
That's a long time.
Yeah, it's funny. I wonder how many actually, quote unquote, annuity professionals are even aware of that.
Oh, very few. I could imagine. I didn't know it, and I'm an annuity professional, so there you go.
And the good news of it is the interest in annuities is I would define it as surging in recent years through more and more acceptance and implementation of the financial and investment and insurance world at large. So all of that is for good reason. You know, an annuity simply is an insurance contract between an insurance company and the consumer, the purchaser, right? And they address a broad range of financial needs, from helping to grow a person's asset in a safe and secure space with solid returns relative to other options that they may have without market risk and volatility. However, you know, annuities also, to be fair, they're not for everybody, and certainly not one size fits all. So it's very, very important that we elaborate and expand upon our wealth of knowledge and exposure to different carriers, and do proper due diligence and education when working with potential clients. And that's why it's so important to establish specific goals that, you know, you, said advisor, want to accomplish and achieve through working with your clients. So I think the first main question in determining which annuity solution might be best for my client is, are we trying to pursue safe growth or
income?
Exactly. That's really the beginning of the conversation.
100%. And you know, the word annuity is for income, right? They are designed to provide longevity insurance to ensure that you don't outlive your asset. And it was always described as annuitization. You essentially give up the asset for a guaranteed income stream. But with product innovation, different type of things that are out there, it is the two bucket option. It's option one is safe accumulation and growth, and option two is income. And that's the starting point of any discussion of implementation of an annuity in a portfolio.
And so with that, you know, take the easy path first of growth. If the conversation of pursuing a growth is the direction we're heading, or the overlying, you know, the overarching and underlying objective, then the question breaks down into two subsets from there. Well, is principal protection, i.e. the conservative path, the ideal solution here? Because if it is, then we have two options: fixed annuities and fixed index annuities, exactly. However, if I'm willing to take a little bit of risk, or some level of risk, and I'm the client who wants to pursue higher potential rate of returns, then you look at these structured annuities. Today we're talking about these R word.
The RILAs.
RILAs, registered index linked annuities, and of course, historically variable contracts, right? Variable annuities.
Correct.
And so from there, you know, just to break down where our real expertise really lies, which is first and foremost easiest to explain: a fixed annuity.
Guaranteed rate product for a set period of time. CD alternative.
Let's not go any further than that.
It's as simple as it is.
And like that, like a fixed annuity, an index annuity offers that same option, but also the option to earn a little bit higher rate of return tied to some kind of an index or a blend of indices, where that index or indices are used as a measuring stick to determine potential interest or rate of return.
Correct. So
that's the difference.
Exactly. And it's that simple. And you're not invested in those indexes, so you have no loss exposure. The principal is protected. It's simply a benchmark, as you said, to show which interest you're going to earn. And if you're looking on a fixed rate annuity, you're 2 to 3% guaranteed interest rate, where we're looking at 3 to 6%, 4 to 6% on an index product. That's what they do. And that's pretty spectacular when you're talking a principal protected no-fee product.
And the contracts on these products range from the short end 2 years up to
Well, 10, but
pretty much 10.
Yeah, and I would argue we focus within 3 to 7 primarily, especially in today's interest rate environment.
Yeah, certainly when you're talking about the growth objective, so forgetting that the income objective at this point in time, it's probably 5 to 7. That seems to be the sweet spot for matching up the timing of the consumer's interests and comfort level, as well as opportunity for yield.
Yeah, and the products of yesteryear of 12, 14, 16-year products, high surrender penalties, these two-tiered things where it's impossible to get out of, those are pretty much all but gone in the industry. There's been plenty of regulation on them. So
yeah, in full disclosure, there are some states who have much more relaxed guidelines, and some carriers who still produce 11, 12, 13, 14-year contracts. So just be aware of that exists. Many states prohibit that now, but some still do. So just in full disclosure.
Yeah.
But certainly from an industry perspective, when you're talking about fixed and index annuities, the predominant premium or sales is 5, 7, and 10-year contracts.
Correct.
Okay. Many, many, many different index crediting strategies that exist. I don't think we should spend time on that today. However, the predominant underlying strategy would be the S&P 500. However, the introduction of many, many more institutions, very large institutions like BlackRock, Goldman Sachs, Merrill Lynch, Morgan Stanley, these companies have now invested in creating index crediting strategies that offer more diversity, have more potential for returns in given markets. And so there's now hundreds and hundreds of crediting strategies that exist.
Correct. And I think a lot of times advisors get wrapped up in what option to choose. What's the best allocation, right? And it's good to know what your diversification options for indexing within the contracts are. Mm-hmm. But we spreadsheet something like 10,000 products. I don't expect advisors and or consumers to understand the difference and nuances between. That's really comes down to more understanding the client profile, makeup, goals, objectives, and then we can help guide to which options, which strategies, will fit that makeup.
Okay, so now moving on, right? So the next option or overarching objective that annuities can provide is in the area of
income.
Bingo. To start that conversation, we've got to ask this question. Are you looking for income now or income
down the road, later?
Later, exactly. If we're looking for income now, what are the solutions that exist? Starting with the most generic, basic option.
Single premium immediate annuity.
Bingo. What is that?
Basically a pension. It's you put money and they turn it into an income stream. You essentially are no longer earning interest on the asset. You're not really having a account value or anything like that. It is basically conversion from asset to income stream.
So what I say is, I'm immediately converting that deposit into an action, which we define as annuitization. And annuitization is when you have given up, in most cases, control or access to the premium that you've deposited in exchange for a guaranteed series of payments. That could be for your entire life as a single life. It could be the entire lives of both you and a partner. It could be guaranteed for life or lives with an underlying guarantee.
Or
5,
just
10,
a year.
20.
Or just a specified year.
Or
10,
just for
15,
a defined
20.
period of time.
Correct.
Which, in lower interest rate environments, that's been less attractive. But if and when we see interest rates rise, then that might become more in vogue, if you will, as an option. It also could work nicely to structure income as part of like a multi-bucketed approach over that client's lifetime life expectancy of 30, 40, 50 years. So I would create a structured income of 10 years, let's just say, to then grow and defer other assets in the portfolio. And when that income stream ceases, then I have another bucket that begins in year 11 and so on and so forth.
Correct. And we've talked about this many of times, and with our designation, the RICP, they even talk about it. What income annuities do is they provide guarantees, no different than the fixed or index products that we just talked about. The guarantees that you can rely on that allows you to invest your other assets more aggressively, right? Because you have this underlying guaranteed asset or guaranteed income stream in the portfolio. It really balances nicely for clients where they have something they can rely on. They don't have to worry about performance. It is going to be a paycheck each and every month or each and every year that they can count on.
Yeah, so before we move on to more of the deferred annuities with these riders, there's another annuitization type of contract that exists that's the opposite of immediate income, and it'd be a deferred income annuity. So tell me a little bit about how those work.
Yeah, putting in a deposit into a contract with future income in mind. So deferring for a set amount of time, getting some amount of increase by keeping it in that contract over years, and then you'll activate income at a future date. So you'll get an enhancement of income, the withdrawal rate at that future date.
So the way to apply a particular case to this would be, I'm 55 years age today. I've got, $1 million in my IRA, and I'm entertaining creating a structured income when I retire on $250,000. So 25% of that portfolio, I want to deposit into this kind of a structured contract, if you will, that'll activate income in 12 years at 67. So the idea would be I turn on Social Security at 67, I activate this deferred income annuity at 67, and now I've created two guaranteed streams of income, one being Social Security, one being from this pension that I created, if you will, that's guaranteed for my life. Now, the trade-off there is, again, just like an immediate annuity or a single premium immediate annuity, I've made that deposit in exchange for foregoing control over that asset anymore or control over growth of that asset. I'm purely exchanging it into an income stream at a period in time.
Yep. With longevity going in today's world, right? People are living longer, especially for spouses, in a couple situation, they're living well into their 90s. Having structured income for an income floor story, like you just said, with Social Security and a pension that you created for yourself. Social Security is an annuity. It's just a deferred income annuity. You've paid into it, and it's going to pay you an income stream at a future date.
Yeah, it's a form of annuitization.
It's a form of annuitization.
Backed by the federal government.
Exactly right. Hopefully you'll be there in 50 years. But yes, exactly. So having that underlying guaranteed income stream is good for people trying to structure income.
And I will last comment to make regarding deferred income annuities is that, and I'm not going to get into the details of this, but as it relates to qualified funds, there are some tax advantages that are made available under these programs where an individual can defer their required mandatory distributions up to age 85. And so for some cases that may be of interest to some.
Depending about the deposit amount and so on. Yes, it is attractive.
Okay, so let's now transition to these, still using the funds to deposit into a deferred fixed or indexed annuity, let's just say, or a variable annuity, any type of deferred annuity, where we're then attaching on a guaranteed withdrawal benefit rider.
Now, what we're finding is, and this is pretty much industry-wide, deferred income annuities in today's interest rate environment aren't very attractive. And the idea of, in your scenario, 55, activating at 67, that's a long time to give up assets and interest earning potential. So the industry switched into these riders attached to an indexed, a variable, whatever, in order to control the asset, earn interest on that asset with future income availability as well.
So is that income annuitization?
It is not. You still have control of the asset. You still have interest earning potential on that asset. It's creating income via the rider, not annuitization.
So those deferred annuities or those deferred contracts remain in a deferred interest earning status for the life of the contract. However, the insurance company is allowing you this option to add on this guaranteed income stream that could be single or joint life. Some of them are just level guaranteed. Some have opportunity to earn increased income as a hedge against inflation with varying options and factors that vary from carrier to carrier. And so the important part there is that the insurance company is now accepting the risk that you're paying for. There is some fee or some requirement that the insurance company is going to require of the owner of these contracts in exchange for them accepting that risk of no matter how long you live, and even if and when that annuity account is depleted to zero, that income stream will continue.
Correct. And they don't all have fees, but they will have some requirement if they don't have a fee, meaning you have to defer 10 years or something along those lines. That's very typical, but they're much more attractive in today's interest rate environment to keep that asset in a deferred status, earning interest as a death benefit and growing your income over time, to even when you activate it, still having interest being earned, still growing the account value or death benefit while taking income from the account.
And the benefit of doing that as an overall financial plan to structure income, again, is, I still am maintaining some control of the asset because it stays in a deferred status. However, I'm satisfying those risks of longevity, protecting the monies against downside risk. And so, as an overall plan, in some cases, I can generate a wonderful amount of income from a yield standpoint, if you will, and allow myself to invest those other monies in a diversified portfolio, maybe even taking on a little bit more risk than I ordinarily would because I've structured enough income to meet my guaranteed needs, my minimum needs. And then we can take additional withdrawals from other sources, maybe in a much smaller dollar amount or percentage amount. So it helps to alleviate the overall stress of the portfolio. Again, this is a situation where you definitely would consult with an advisor and work this in the context of an overall retirement and income plan.
Correct. And not all products, not all carriers, not all scenarios are the same when it comes to income. And so deferral years, age of client, all these things, how much do you want guaranteed versus potential income? These type of things all come into play. And so it's really important to work with someone that is not just one product, one carrier, not just going direct to one insurance carrier, having a holistic approach to this discussion, looking at all available options and finding the solution that fits best for that specific case is key. Because, one product might be attractive today, but next week it might not be. Or a new product might come out. And if you're only working with one, or you're only seeing the commercial on TV for that one insurance carrier, that doesn't mean it's the best product. Just means they're spending a lot of money for that commercial.
Very well said. Yeah, absolutely. Okay. My first question was a little bit of a trick question in terms of what are the solutions that annuities can provide. And we said growth and income. But that's not all.
No.
Day in and day out, one of your main expertise is in the area of
long-term care.
Bingo. How can annuity work as a part of a long-term care solution?
Yeah, it's actually very attractive for a lot of people because it stays as an annuity. It's a tax-deferred vehicle earning a fixed interest in most scenarios. Some are indexed or even variable annuity chassis that then have a long-term care rider attached to it that's going to provide you some leveraged amount, 2, 3, 4 times your initial deposit for tax-free long-term care. And that'll be paid out at a set period of time based on the product, 3, 5, 7 years, whatever that product is. So it essentially creates the guaranteed safety that we already talked about, some tax-deferred growth potential, albeit minimal, but some tax-deferred growth potential, but you're getting leveraging tax-free for long-term care.
Are all long-term care riders created equal?
No, definitely not. Every single one is different. How they are filed product-wise, like tax classification, matters. A true long-term care product is defined as a 7702B as in boy. And those are true long-term care products. Those are true long-term care riders. Other ones that are out there are impairment multipliers you might hear, or
enhancements.
Enhancements, correct. Other ones might be a critical illness rider where they just simply waive surrender charges on the contract if you're in a nursing home, things like that. So each one is really unique. But when you're talking long-term care specifically, you want long-term care protection, you want to focus on a true long-term care annuity.
And how are benefits triggered through these 7702B long-term care annuities?
Identical to any long-term care policy, traditional or hybrid. It's 2 of 6 activities of daily living. You're unable to perform 2 of 6 activities of daily living as deemed by your medical care professional.
And those would be bathing, eating,
dressing, transferring, continence, using the toilet.
And what about cognitive impairment?
Cognitive impairment, always. That's the number one trigger for any long-term care event.
Okay. Now, how does the Pension Protection Act come into play as it relates to annuities?
Yeah, the Pension Protection Act was very favorable for the use of existing non-qualified annuities for long-term care purposes. So what the Pension Protection Act, PPA, states is that you can take a non-qualified annuity that has taxable gain. So how are annuities taxed? Testing you.
That would be last in, first out.
Bingo.
As ordinary income.
As ordinary income. Correct. So you have taxable gain in a contract. Put $100,000 in. It's now worth $150,000. You have $50,000 of taxable gain within that contract. Well, if someone needed it for long-term care, as it sits today, if they start pulling money out of it, they're paying taxes on that first $50,000 as ordinary income. Mm-hmm. Now, the Pension Protection Act stated that you can take that annuity and do a like-kind exchange called a 1035 exchange into a PPA-compliant annuity. And what it does is it eliminates all that taxable gain for long-term care purposes. So now that $150,000 that you had that was taxable, $50,000, is now $150,000 fully tax-free for long-term care purposes. Still sits exactly the same annuity chassis. Now, what they also have on these PPA-compliant annuities is an enhancement, 2, 3 times leveraging on that. So that same $150,000 now turns to $450,000 tax-free, eliminating all the taxable gain within that contract for long-term care purposes. So when you have clients that are sitting on annuities, they don't need them for income, like old annuities, don't need them for income, don't need them for any other purpose other than rainy day fund, why not move it from one annuity to the other and pick up this leveraging tax-free? It's a much more favorable position for the annuity to sit.
Yeah, certainly those who are in their late 60s, 70s, their income needs have been met. They've got, we throw around the term dusty money that's typically set aside for emergencies or beneficiaries, really.
Yeah, and why
not put it to work from a tax-free standpoint if and when you or your spouse, right? Some of these can be made available not just for me as the owner of, that particular contract, but I can also add a spouse to receive benefits,
Yeah,
correct?
single owner, single insured existing contracts can add a spouse for the long-term care benefits on these. Other things, they're not age dependent, meaning a 65-year-old is going to get the same leveraging and same benefits that a 79, 80-year-old are going to get. So that's very attractive because any other long-term care product on the market today, traditional, hybrid, whatever you want to call them, there is a leveraging component that diminishes over age. With these products, they do not.
So with 10,000 Americans turning age 65 every day, I would argue there's a few opportunities that exist or areas where annuities become a pretty worthy solution.
Definitely. Think about all the clients that purchased variable annuities, have risk within the portfolio. The income riders are no longer being used. They're still paying fees 2 to 3% per year for a product that is probably not going to be used for what it was intended when they purchased. I bet there's many clients, millions and millions of people out there that have that can reposition those assets for a more prominent reason in their later years.
Yeah, another thing too is all too often we come across individuals who've purchased an annuity contract and they haven't regularly had it reviewed or consulted upon on any level. I mean, we see that day in and day out of purchases that have been made and nobody's talked to them since it was purchased. And sometimes it's 5, 6, 7 years ago.
Yeah, quick story. I just had one come across my desk last week, and it was a variable annuity that was sold in 2000. So it's been 21 years, 22 years, this thing's been in force. 100% of the time over the 22 years, it's been allocated into the money market sub-account.
Oh my gosh.
It has negative return over 22 years. Imagine what that asset would have done just in anything other than that money market. So exactly to your point, if you're not doing an annual review, how are you even knowing what that contract's doing? Is it performing how it's supposed to? Is it allocated where it's supposed to?
Set it and forget it is not
No.
the optimal solution.
No. Even
Contracts change too.
Exactly. And client situations change. Going back to our income discussion on some of those index annuities, variable annuities where you have an income rider, well, what gives you even more flexibility in those contracts is you have the ability to turn on and off income as needed. You're not annuitizing. So things change in your annual reviews you're doing with your clients or the client is doing. You can make those elections if your circumstances change. So yes, it's critical to continue to review your contracts quite frequently.
Well said. Lots of content covered today.
Definitely, and there's so much more wealth and knowledge that we would love to get out to people if they would listen, for sure.
If you're interested, you can reach out to us. You can look at our website, www.producerschoicenetwork.com. Your phone number is
838-0448.
Nicholas Bernatowicz. Thank you for joining us.
Thank you.
Till next time. Thank you for tuning in to today's episode. Please subscribe, like, share, leave a comment or review. Be sure to check us out on social media at Optimized Advisor Podcast. Till next time.